Good morning, everyone. Welcome and thank you for joining our webinar today. And this is Jyoti, and we are thrilled to have you here with us on a Saturday morning. In today's webinar, along with Sudhir, we have with us Anup Nayak from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclaimer slide that our attorneys mandate that we show prior to every webinar. If you have any questions during the presentation, please feel free to type them in a Q&A box and we will have them during our Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us on 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti. Very good morning, friends. Today I'm in California, so it's a little early for me. But it's our commitment to the community that we do these webinars every week, every Saturday at 11 a.m. Central Time. Uh, so today, we have given a title to our webinar as Real Gold, Digital Gold, Liquid Gold versus Tech. What is that we should invest in and why? So before going to that topic, let me quickly take you through what happened during the week. The week indeed was very volatile, like every other week that has been going on from the last couple of months. And primarily, the reason behind this is the tariff uncertainty and most of the businesses not having clarity as to what they should be doing in terms of expansion of their business. Should they relocate their business to US? Should they move their business from China to Mexico or Canada to Mexico or to Europe? So all this confusion exists in the heads of the business leaders who run the companies, and that is what causes uncertainty and lack of guidance when they're announcing their earnings, and all of that causes panic in the market, and sell-offs takes place because there are talks of recession, sectoral recession, uh, and many other things, quantitative easing, quantitative tightening. So a lot of things going on. So with all of that, we saw a week of volatility, but the good thing is we ended the week on a positive note. So the last week we have also had a lot of macros as well as the FOMC, Jerome Powell speaking about you know uh, things like the revised GDP and unemployment numbers, and a position that he took that there is not going to be any interest cuts for this quarter, and for this year there may not be maybe as many as the market may be expecting. So the GDP forecast has been lowered by FOMC to 1.7% from 2.1, which is not such a great news. And they also raised the inflation expectation to around 2.8 and unemployment number to around 4.3. So overall, what he says, Jerome Powell says, is economy is strong, tariff is creating uncertainty about the future, and because of all that, we will have to wait on further interest rate cuts. So that is what is going on. Wait and watch. April 2nd marks to be a very important date, hopefully, unless Donald Trump doesn't change his mind again. It is the day when the reciprocal tariffs will come into existence. Reciprocal tariffs means, if there is a country which charges X% on certain goods to the US and US did not have any tariff on that country, from that day onwards, US also is going to charge the same percentage of tariff for stuff that is coming into US. So any goods coming in the US and putting these tariffs, Trump wants to generate revenue for the economy, and that is what is causing all this uncertainty and turmoil. Because any additional tax on goods coming into the US can lead to higher prices. Higher prices will lead to higher inflation, and higher inflation means Fed is not going to cut any interest rate. And not cutting interest rate means, again, small businesses suffering with higher cost of capital, and all of this leading to a recession. And we don't know when. There may be some sectors which is already in recession, but a full-blown recession, there are different banks talking about different quarters, different years. But I personally think, and again, this is my personal opinion, I personally think that 2026 is going to be the year where we may see some real recessionary news, because it takes a couple of quarters for all this tariff news to hit the uh, numbers that a business generates. And I think that is going to give an opportunity for us to invest in a deeper correction in the equity markets. But we will wait and watch one day at a time. So if you look at the daily chart of S&P 500, which is the market which reflects the direction, meaning it's kind of hovering around that 5500 level, which is below the 200-day moving average. So we are yet to see the momentum pick up, positivity come in the market. That's when momentum picks up. So once that momentum picks up, we can be very confident that the market is again back, uh, and uh, uh, and uh, and there is a lot of positivity in the market. As I mentioned, the reciprocal tariff on April 2nd. So hopefully we should get prepared for that date and uptick in stock prices. So let's see how the next week goes. Next slide, Jyoti. Jyoti, next page, please.
Yeah,
Jyoti,
I
can you hear
have
me?
I have changed it to next
Hello.
slide, sir.
Okay, okay. Yeah, now I can see it. Okay, is because every week what I do, I kind of give an idea about what has happened in the market and why, and then also kind of bring up a very important point which needs some discussion and presentation of certain facts. So if you look at this slide, there is a comparison between real gold, liquid gold, which is oil, digital gold, which is Bitcoin, and technology, which is basically very important for innovation to take place and changes to happen in the real world. So if you look at real gold, the 1 year, 3 year, and 5 year uh, numbers, 1 year gold has performed almost 41% growth over the last 12 months, which is like phenomenal. And the 3 year growth is around 16%, and the 5 year is the same. And if you see over the last 5 years, how many times has gold gone down? What is the maximum percentage gold has gone down? So that's 21%. So gold has done extremely well. If you look at a 5 year average return of 16%, that's like solid return. So gold has beaten the S&P 500 uh, by 2 times. Now look at digital gold, which is Bitcoin. Bitcoin has a downside of almost 77%, meaning if Bitcoin comes down, it can come down up to 77%, which means this is an asset that you should hold and not worry about it going down so much, because there is a scarcity of gold and Bitcoin, meaning you cannot just keep drilling and getting more and more. Gold is only available in certain places where mining takes place. And Bitcoin, there is a limit of 21 million Bitcoin, and it will take another, 120 years for all those 21 million Bitcoins to be mined. And every 4 years, Bitcoin mining doubles in terms of effort. So if you look at the returns of Bitcoin over a 5 year average, it's 69%. One of the best asset classes today that we have. And that's why most of the countries, including the US, has decided to set up a strategic reserve. And most of the companies are today taking a position in Bitcoin, because whatever money you don't need for today, you don't need for a few months, you don't need for 1 year, 2 years. If you park that in crypto, such as Bitcoin, that money will grow exponentially higher, because Bitcoin is part of blockchain. It's a token on the blockchain, and the tendency of that to go higher is very, very high, because blockchain is the next technology which is going to take over the internet. And this technology is called Web3, and it is on blockchain. And there are a lot of benefits of blockchain getting adopted and all the businesses moving to blockchain. So because of that technological improvement that this can bring, and the limitation of Bitcoin to be 21 million coins, the performance of Bitcoin over long period of time is going to be phenomenal. Looking at liquid gold, which is oil and gas, we call it oil and gas, but here we are talking about oil, petroleum. If you look at oil, the drawdown is almost 63%, because even that's a commodity. Commodity can go up and down a lot. During COVID, nobody wanted oil. Oil was spilled, thrown, because there was zero consumption, because everyone was in their homes, and the usage of petroleum in cars and other places was reduced. And because of that, the drawdown, meaning the amount of loss you can see if you are holding oil, is 63% over 5 years. Okay. But if you see the 5 year average return, it's 20%, the green bar. But if you look at the 3 year average return, so if you are holding oil and looking at 3 year average, you are in a loss. If you are looking at 1 year, you are at a loss, right? Now you look at technology, which is our NASDAQ 100, QQQ. The, the 5 year drawdown is 36%, not bad compared to Bitcoin. But look at the returns of last 5 years. It's 22% versus 69% of Bitcoin and 16% of gold and 20% of, you know, in petroleum. So what does all this mean? There is no one thing that is good or bad, right? You need to have a diversified portfolio of stocks and commodities. And when you look at stock, you should think of American stocks, Chinese stocks, Indian stocks, European stocks, German stocks. So, where do we invest our money? The answer is very complicated. The answer is one simple word, is diversification. You need to put money into multiple buckets and take the percentage based on your your profile of investing. Where do you stand in your life in terms of, your need for cash flow? If you are in your 30s, because you're earning very well, you need to invest more in growth assets. If you are at your 70s, you can't earn anymore, and you need to earn income on the savings that you have. So you should be looking at income assets such as dividend earning stocks, structured notes, private credit, infrastructure. We will talk about all that in the upcoming slides. But the answer, after all this, looking at all these four types of asset classes, which is real gold, digital gold or crypto, liquid gold or oil, and technology stocks, which are going to generate huge amount of growth for the world because of technological innovation. The answer to that is diversification, and how much to invest in each is a matter of your personal risk profile, and we need to discuss that one on one. Next slide, Jyoti. Okay, so this slide shows why oil was an underperformer, and why it is going to be an underperformer. Again, nobody has a crystal ball. If everybody knows that oil will be an underperformer, it would have been a very good thing so that we can avoid oil. But they say, buy things when it is down and sell things when it is high. So right now maybe is the right time to buy oil, right? We don't know. Or maybe wait for some more time. Why should we wait for some more time? What are the reasons for oil prices to go down further? That is because, US wants, the world wants inflation to come down, because inflation has been very high since 2021, because the entire world printed a lot of money, and that money created inflation. Now, for that money to be sucked out of the system, the government has to issue bonds and things like that, so they can pull out that money, and people are holding on to bonds, or inflation is not going to come down. So for inflation to come down, the second thing is they need to reduce the cost of inputs. So what they do, what is that input that is required for every industry? It is oil. Oil is required for every industry because transportation cost is one of the largest cost, and transportation you need oil. So Donald Trump wants to, drill on the US soil, which the Biden administration had completely banned. So he is opening up the US for drilling, and that could bring down the price of oil. And also all the monetary tightenings that are going on could reduce demand and may reduce the cost of the price of oil. And also the Middle Eastern government, there is enough pressure on them to reduce the supply, and or increase the supply, and based on that increase which is required to bring down the cost of oil, uh, the pricing of oil may go down further this year, and we may see oil to be an underperformer. But again, we don't know. There could be another COVID, there could be some other war outbreaking in some other place, and all of that increases the price of a commodity, including oil, and anything is possible. But as of now, the focus on oil is to lower the price of oil. Next slide, Jyoti. Okay, why gold tends to outperform? Because gold is considered as an hedge, meaning when people are worried about the equities, about the stock markets, they tend to hide in gold. They move the money to gold, particularly, large family offices, institutions, countries, sovereign funds. China accumulated a lot of gold because they want to destabilize the dollar, and they don't want to hold dollars because dollars can be volatile, and they felt gold and Bitcoin is a better asset to purchase. So many countries are buying gold over the last few months and continuously every year, and as well as Bitcoin. That's why you see gold and Bitcoin really outperforming other commodities. And whenever you see the market go down, that money flows into gold. And that's why we are today seeing gold close to $3,000 plus per ounce. Next slide, Jyoti. Okay, Bitcoin versus global liquidity. When does the price of Bitcoin go up? Those who believe in Bitcoin, I am a great believer of crypto. So we are actually launching a crypto fund in a week or so, because this is the time to enter into crypto because the risk levels have gone down significantly. because it is proven that Bitcoin cannot be cracked. Bitcoin is something that every country wants to hold. US has come up with the strategic reserve idea, and one of the most famous person who believes in crypto is David Sachs. He is appointed as the crypto czar by President Donald Trump, and there is a lot of potential, impetus to Bitcoin and other cryptos, and to for the US to take over the position of being the uh, uh, you know uh, most important place in the world where the hedge funds, the crypto miners, and other companies which are associated with crypto, trying to generate multiple companies on crypto or blockchain, layer 1, layer 2. Those companies are being invited to the US because they have been fleeing to countries like Abu Dhabi and Dubai and other countries. So that is reversing now. So US has taken a stand. The current administration has taken a stand that they are going to adopt, crypto, and they are going to, put some controls on some issues like money laundering, terrorism, usage of this currency for terrorism and things like that. So they are going to bring some control. They are going to create a strategic reserve. They are going to hold a lot of cryptocurrency, and that is going to push the price of crypto in the coming years. And one other reason why Bitcoin in particular goes higher, as the country starts printing more money, as the world starts printing more money, is because when they print money, money loses its value. That's why inflation goes up. But because Bitcoin is limited in its numbers, which is maximum of 21 million coins, the price of Bitcoin prediction is that it will go to $150,000 by end of the year. Some people say that, some experts who believe in crypto think it will go to $1 million by end of 2030. So, because there is a potential for creating generational wealth, okay, for you to create generational wealth out of your money instead of holding it in some wrong asset, the answer is buy the right asset. And here we are speaking about what may be those assets for you to hold. If you're, in your 30s or 40s, you have another 40, 50 years, it may be a good idea to buy something which may have volatility but still is going to grow very high, right? Or if you are much older, it may not be a good idea for you to dip your feet into Bitcoin or other crypto, because you don't want to create generational wealth when you are in your 80s, because your next generation has to take care of that, and you don't want your money to go down so much when you need it. So, deciding how much to invest in Bitcoin, how much to invest in gold and stocks, and of which countries, is very, very important. But for Bitcoin, the reasons why it will continue to go up is because every country is going to print more and more money in the coming years, and the price of Bitcoin is going to go higher and higher, and it will continue to happen. Next slide, Jyoti. Okay, regarding the tech sector, we have seen a wonderful growth in technology in the last 2 years. And if you look at 24, the estimate of earnings and estimate of revenues has been much higher, and because of that, we saw an outperformance, outstanding performance in the technology stocks, particularly the seven large companies, Magnificent Seven, which is Nvidia, Microsoft, Amazon, Google. Uh, these companies have really outperformed from 23 and 24. But 25, there is a little bit of a concern because of all the, global wars and tariff wars, trade wars going on. And also because, the AI hype over the last 2 years was really high. So there is also a concern whether it's a bubble or it's real. So all of that, as well as the estimates of earnings and revenues, is much lower compared to 23 and 24. So if you see Q1 of 2025, the revenue growth is around 10% for technology and about 12.7 in terms of earning, which is not bad, but it's going to go down, and that lowering of technology growth may create not such a big growth spike in the index and the technology companies. So it's you are better off putting money into small cap stocks, mid cap stocks, non-technology stocks because there is value. And I'll take you through our portfolio models and I'll show you how money is now moving out of technology and going into value. Next slide, Jyoti. Okay, so what are the different noise or news that we are going to hear next week? So we'll have the manufacturing PMI, which means we'll get to know, how is global manufacturing doing. There will be consumer confidence for March, new home sales for February, and Q4 GDP numbers. 2.3 is the forecast. If you see that to be good, there may be a different impact of that. And then jobless claims, and then core PC, inflation, core inflation. So, all of these are very, very important numbers, which is going to increase the volatility or ups and downs in the market. Good news will take the market higher, and interpretation of these news on future of companies and future of countries and things like that is going to impact the market. So be get ready for another volatile week next week and enjoy the ride. Next slide, Jyoti. Okay, so here are the performances of our models and the indexes. S&P 500, the second line on the left side, for the year is down by 3.77%. For the week, we saw 0.21% higher, and for the month, we are down by 5%. And if you look at gold, it was up 1.18% for the week, and for the year, it is up 15%. Gold has really done well, very well. If you look at Bitcoin, it's down by almost a percent for this week, and for the year, it's down by 11% because last year, November to end of December, it really went very, very high, and that correction is what we are seeing in 2025, the first half. And if you look at our models, we have two types of models, the ETF models and the individual stock models. If you look at the ETF models, uh, the boxed items, metals and crypto, which is gold and Bitcoin and Ethereum and silver and copper, it's gone above the S&P 500's negative number. So we are positive by 1.5%. International markets has done very well. We have countries like Poland, India, China, Europe, Germany. All of these countries have performed very well, and we are seeing a growth of around 8.35% for the year, which is almost 2.5 times of what the S&P has delivered. And then if you come to the right side, our all-weather model is more or less equal to S&P 500, but still it is a little better because it's a very balanced model. If you look at China, it's up by 25%. So China is doing very well after 2 years of getting beaten down. Now, let me take your attention to the ETF model, first two line items, S&P 500 growth and S&P 500 value. So growth means companies which are like Nvidia and Tesla and Microsoft, all the technology companies and all the other sectoral growth companies, which means they are growing and they're not generating a lot of cash for paying dividends and things like that. So growth has underperformed, meaning for the year it is down by 4.5% because there is something called as growth scare going on because of all this tariff stuff that is going on. Now the second line, which is value, which means the other companies in S&P's 500 companies, which are which are not really the ones that went higher in 23 and 24, and it has value, meaning they are lower in terms of price point. And today investors are looking at putting money in those companies. For example, if you think of a company like Nike, they make shoes, and who cares for shoe company when they are seeing so much upside in Google? But is that going to continue? Is that technology growth going to continue? It may, but not as high as what we saw in 23 and 24. So there may be a rotation of money from growth to value. And that's why if you see the year to date numbers of value, it's up by 2.13%, while growth is down by 4.5%, and the blend of the two is up by 0.44% in our model. But if you look at S&P 500 as a whole, it's down by 3.77% because the weights of growth companies is much higher in S&P 500, whereas in our model we have tried to balance it out, right? So now coming to the right hand side under the custom models, most of my clients are in the model which is called custom IBKR. And custom IBKR is a combination of all the models that we have on the left side, which is we have certain percentage in growth, certain percentage in value, certain percentage in next generation companies, in small cap, metals and crypto, international. A combination or a combo of all those model is what you see under custom IBKR and custom Schwab and custom margin. That is where our clients tell us, Sudhir, you take a decision on our money. You guys are the experts. You have good knowledge on what is going on in the market. That's your full-time job. We will give you our money. You please treat your money as our money, and we will trust you with the managing our money because you guys are active managers. You are not simply buying a bunch of 10 stocks or 10 ETFs and just leaving it to God. We are going to manage it, meaning we are going to see the movement of money, how the smart money plays, and we are going to make those adjustments in your portfolio. Okay, and that is why our goal is and our expectations are that we are going to beat the S&P 500 by a few percentage points. And we will try to reduce the drawdown, meaning when it falls, we want to be protected to an extent. Right now, our models are 100% invested, but 2 weeks ago, our models had around 5 to 7% in cash and hedge just to buy the dips, sell high, buy low. That's the formula, but most of them do the opposite. And that's where active management comes into picture. Next slide, Jyoti. Okay, so that's about the market, and now let's talk about some of the structured notes that we have, which are closing on April 4th. This one, we shared this note information last week as well. This is a note, and the stocks that are being used for creation of this note are Facebook or Meta, Microsoft, and Amazon. This is a 3-year note. So the way this note works is at the end of 1 year, after holding the note with the end of 1 year holding period, if all the shares are positive, doesn't make any difference if it's positive by 1% or 10% or 0%. If it is positive, you get 30% return. If all the stocks are positive, you just make 30% return. If you invest $100,000, you get $130,000. Done. And we do this in Charles Schwab. We open an account for you, place the trade on April 4th, and you will have $130,000 at the end of 1 year if all of these three stocks are positive. If they are not positive, there is nothing to do. This note goes all the way to the end of 3rd year because this is a 3-year note. Now the question that comes up often, oh, if it is for 3 years, if I want to get out, can I get out or am I stuck? Because investors want flexibility. The good thing about this structured note is it's very flexible. If you want to get out in like 10 days, you can get out. But like anything else, when you buy something for 3 years and when you sell something within 10 days, you have a potential loss, right? Because when you sell in that kind of a situation, you are either doing it in panic, you are scared, and stock market is not for those, stocks are not for those, structured notes are not for those who get scared. It's for them who are patient, who understand that in the market there are players, there are vultures, and the panicked investors are the one that will get eaten off. So this is for someone who are patient, and because this is a 3-year note, but doesn't mean you cannot take the money out. If there is an emergency, you need money for your kids' education, we can sell this note in the private markets and get you the money within 2 days. Okay, and you may not lose any money if these three stocks are positive on the day of sale. Everything depends on the price of these three stocks. Now, what happens at the end of third year if it crosses the first year because they are not positive? They go to the third year. In the third year, whichever company has grown the least, let's say Microsoft is the one that has grown only by 30% in 3 years, then you get 3 times 30%, you get 90% return. If Meta has grown 50%, Microsoft has grown 60%, and Amazon has grown 100%, because Meta is the lowest growth stock, which is 50%, you get a 150% return, the lowest performing stock. Now, the next question is what happens if the stocks are down? Now, if one or all the stocks are down, you take the stock that is down the most. Let's say in our example, Microsoft is the one that is down the most of the three. It's down by 50% at the end of third year from April 4th, 2025's price. So the price is always fixed. The price of the note is always fixed on April 4th. At the end of year three, if the price of all three has fallen, or if the price of only one company has fallen, you take the lowest price. Let's say Microsoft is down by 50%, you get your money back as is. Whatever that 100K you put comes back as is, because you have a downside protection of 50% on your money, which you don't have otherwise. If you just buy Meta, Microsoft, and Amazon in the equity market, in the stock market, you don't have any protection. Whatever it is, it is. But here you have 50% protection from today's price. That means these companies have to be down by 50% by the end of third year. The chances of that happening is there, but very small, right? Because if something comes down, it has to go up. Now, the bad luck of an investor is if it falls only in the third year. Let's say COVID comes at the end of third year and the stock goes down 60% for a few days, and that marks your third year anniversary. That risk is there. So every investment has risks. If you don't want risks, then you'll have to keep the money in your safe deposit or in a CD, earning 4%. That's your option. If you want to take risk, that's when you make returns. And this is for those who want to take that additional risk, but mitigated risk with the downside protection of 50%, and you get your money back, and with the upside participation of up to 3x or 30%. Now, what happens if Microsoft is down by 60%? Right? Possible. In that case, you lose 60%, you get only 40%. Up to 50% you're covered, but below 50% you lose all that. If you're down by 60%, if Microsoft is down by 60%, you get only 40% back. That is your real risk. Okay. But what are the chances of Meta, Microsoft, Amazon going down by 10, 20, 30, 40, 50%? Please do your research or ask us, and we can give you some idea on how much has been the drawdown of these three companies over the last 15 years. We can answer that question. And other thing is, these are three solid companies. The future companies have so much of cash. They are part of S&P 500. S&P 500 is part of the other investor because they are in the index. Every sovereign fund, every family office have invested in S&P 500 US companies. So you are kind of covered. And the second point, how much money can I put in this note? That depends on your overall situation. Most of my clients put anywhere between 25K to $1 million in a note, depending on how much liquidity they have. A $50 million investor may just put $500,000 in this, marking it to be, a 1% investment in this, right? Uh, Similarly, an investor who has $100,000 may decide to put, only $20,000 in this out of the liquid cash. So, we can answer your questions on one-on-one basis. Please call us if you have questions. Next slide, Jyoti. Okay, so this is a note which is principal protected. Those who are worried about that 50% going below 50% and people losing money at the end of third year, this is for those, this is principal protected note. You never lose money because the markets are down, right? So here what happens at the end of every year, If the stock is flat or positive, you make 12.75 in the first year. Second year, you make double of 12.75 because it's in the second year. And in the third year, you will make three times the returns of the index. So there is a highest, that's the highest potential for you to make money if the market continues to remain down for 1 and 2 years. And on the downside, you are protected 100%. At the end of year three, if this index is down by 1 or 100%, you get your money back. There is no problem. Okay, this is a note for those who want their principal to be absolutely protected. There is one of our clients who wanted to invest $1 million, and we created this for just for him. But he was kind enough to say that if you want your clients to invest in this, feel free to market it. And that's what we are doing here. If you are interested in this, please let us know. And if you want to, let's say, put 50% of your liquid cash in the first note and 50 in this, we can do that as well, right? 25 in this, 25 in that. And you can invest in these two notes from your old 401k plan, from your corporate treasury account, from your regular account, from your kids account, anything, any type of money is good for these two notes. So do let us know if you are interested in investing. But there is a deadline of April 4th for the previous one and April 11th for this one. Next slide, Jyoti. Okay, so this is not based on equities, meaning this is not public equity. This is a fund. This fund is called Ares Core Infrastructure Fund. Ares as a company is a public company and they create funds. They are a financial company like Blackstone and KKR and Apollo. Few of the largest companies in the US. This is the total money that this company manages is around $525 billion, not one or two, but 525. These companies have not lost investor capital, because of their sheer size and diversification within the fund. So if you look at this fund, the fund is a $750 million fund. So there is a lot of money, and a few percentage points here and there really does not affect, because the cash that this money is generating is close to 12% or 13%, because this fund invests in companies that is building the future of American infrastructure. So with all the growth that is happening with the artificial intelligence, EV, electric vehicles, the growth of data centers that is happening, lot of money needs to be invested in energy like wind power, solar power, natural gas, and all of this infrastructure upgrade that is happening to the power grid, which is quite old in this country. The whole power grid is getting upgraded using this money that we invest. That is why it is called as the infrastructure fund. The returns that this fund is talking about is around 10.7% per year. So there is no downside like the other ones, because it is not putting your money in public equity, which goes up and down because people gamble in the stock markets. These are private companies' investment, and whatever cash flow they generate is the cash flow what investors make. The returns are around 10.7%. That is the distribution rate that is going on. And they think the target returns, meaning the overall IRR for this fund every year is going to be between 10 and 12%, 12% on the higher side. Out of that 12%, 10.7% is the current cash flow that they are giving. Now, the good thing about this fund is that cash flow that they are issuing every quarter is treated as return of capital and depreciation, which means that money is not taxed. You will not pay tax on that money. So if you gross it up because you're not paying tax, it is like equivalent to around 13% return. Let's say you get 13% in an FD and you have to pay 37% US tax. That is going to lower the returns to almost, you know, 9% or 8.5%. Whereas if you invest in this, when they return the money, it's treated as capital gain. So capital gain in this country is taxed at 20% versus 37% on regular income. So the difference between the two, the 17%, is what gets added back, and your tax efficient yield is around 13%, 12.84% to be precise. So there is no guarantee that you will keep getting 10.7%. It depends on the returns that this fund makes from their investment in all these companies. And these companies are into power and digital infrastructure of America. And this is not a small company that we are looking to invest. This is a large company, listed company, which has created a fund purely to, invest in infrastructure and energy generation company of America. And given that the current administration under President Donald Trump is focused so much on building America or making America great again under the MAGA law, you know, this fund, I think, is going to be a very good investment. Again, how much money to put in this is a question of your liquidity and your risk profile. This is meant only for accredited investors, meaning you need to have annual income of $300,000 between you and your spouse, or you need to have a net worth of more than $1 million. And the distribution of this money is going to happen monthly. And if you want to get out of this fund, you can always submit a sale and get out of it every quarter. The first year, if you want to get out of this fund, there is a 2% early redemption fee. But after 1 year, there is no 2% fee also. So it's quite liquid. The returns are pretty decent, almost 13% tax efficient yield. The fund is large, giving it a lot of comfort to investors that this is a big fund with a big company. The chances of losing capital is quite distant. Anything is possible in the world of investing. My job is to keep telling you that again and again, because whoever tells you your money is 100% guaranteed, 100% protected, there is nothing that will happen. All that may not be right, because we have seen during COVID that a lot of industries went through bad times. Hospitality, hotels, all of them, which are very, very strong, assets, even they suffered. So you never know what will happen and what could be the impact of that happening on our investments, right? So it is very important to always understand the risks and not put all the eggs in one basket. You don't want the basket to fall and all eggs to crack. It's very important. That theory is very important. Some of them don't like what I say because I am conservatively aggressive. I'm not aggressive and super aggressive. I want to make sure that I don't lose the money which I invested after working so hard, and I make a return which is aggressive enough to keep me happy that I did well. So it's very important you go with that philosophy so that you don't have to regret in the future. Next, Jyoti. Okay, that brings us to the end. We will take questions now. I have my colleagues Anup and Jyoti here. Others may also be there, and we will take questions now. Please type your questions in the questions box, and we'll try to answer as many as possible. Thank you.
Thank you, Sudhir.
Other questions, please type in, especially if you have any questions on the two structure notes that Sudhir spoke about and also on the infra fund. More than happy to answer those. I think the webinar was so detailed that there are no questions. We'll probably wait for a minute or more. If anybody has any questions, please type in. If not, we can wind up after a minute.
There are few questions, Anup.
Okay, I could not see that. Would you mind reading it for me?
The first one is infra fund always available to invest or has a deadline?
Infra fund is an evergreen fund, and so it can be there's an option every month to invest. So it can be, you can reach out to us, and it can be invested on a monthly basis. So there is no deadline. It's an evergreen fund.
Okay. The next one is what is the minimum investment for MMA?
Yeah, again, the minimum investment for a new client is 50,000, and for an existing client is 25,000. But please reach out to us, and we can definitely help if you're interested to move forward.
Okay, the next one is can you please talk about crypto fund?
Yeah, so the crypto fund that is being launched, and as Sudhir said, we'll have more details coming up in next few weeks. And once we have those, we will definitely share that information. But please do write to us so that we can respond once we have the materials available. But that should be available in next couple of weeks.
Okay, the next one is Ares Infra Fund is a capital protected.
So as Sudhir said, these funds are not principal protected or capital protected, but the past performance has been good, and they have been giving decent returns. But from a principal protection or capital protection, it is not.
Okay. So I think we had only those questions. We'll just wait for 1 or 2 minutes.
Sure.
Do you invest in I think it is international market?
Yes, in fact, I think Sudhir also mentioned about it. We have a portfolio specifically on the international market. If that was the question, when it comes to portfolio, we have the stocks and ETFs that are related to international portfolio. And yes, through that means we do invest.
Okay. Thank you, Anup.
Yeah, I think if there is nothing else.
Will it not be too late getting into crypto investment if you wait for a few more weeks?
So again, Sudhir also mentioned that there is no perfect timing for any of these investment, especially on the stock market and ETFs. But then remember, he also spoke about the potential with the limitations that we have got in the crypto with the 21 million units that we have got. So yeah, again, timing is something that nobody can predict. But I think once the funds are the details are available, you can go through that and you can take a judgmental call accordingly.
Thank you. Any funds for saving the taxes?
So right now we would come out with some tax deferred funds, but we'll have to wait for at least next 1.5 to 2 months. By that time, we should be having some funds that should help you on your tax front for 2025.
Okay. Maybe we can wait for another minute or so.
Yeah.
Right now we have only those many questions.
Yeah.
Okay. Thank you everybody for attending on a Saturday and for your time. And if you have any questions, you can please write to us on wealth at mytimeequity.com. Or if you have any questions, you can also call us on 972-330-2771. And thank you once again, and have a good weekend. Thank you, Anup. Thank you,
Yeah,
Sudhir. Bye-bye.
yeah. Thanks, Jyoti and Sudhir. Have a good weekend. Bye.
Bye-bye.